The Nuburu Inc. stock, trading under the ticker BURU, last closed at $0.34 on Thursday, October 17, 2025, with the market now closed. This closing price represents a near flat day-over-day change, following a period of extreme volatility. The immediate insight that investors need to grasp is that while the stock price appears to have stabilized in the low 30-cent range right now, this stability is merely the eye of the storm. The true dynamic at play isn't in their core blue laser business, but in a dramatic, almost complete pivot toward the defense technology and security sectors, driven by recent, highly dilutive financing and a string of aggressive acquisition announcements. If you are watching Nuburu hoping for a rebound based purely on their original industrial laser technology, you are looking at the wrong company. The expectation for many retail investors is a simple deep value or turnaround story based on their innovative blue laser, but the reality is they are executing a strategic transformation that essentially replaces the foundation of their business model, moving from a capital-intensive manufacturing approach to a more scalable defense tech and software as a service or SaaS platform. This transformation is the core thesis now, and it's why volume has surged and the stock has whipsawed so violently. The common understanding of Nuburu Inc. for a long time has been that of a promising but commercially struggling pioneer in high-power blue laser technology. They created a niche in welding and additive manufacturing, think 3D printing, for highly reflective metals like copper and aluminum, a critical area for industries like electric vehicle battery manufacturing and consumer electronics. The market was excited about the potential applications here, seeing it as an essential component for the electric mobility push, maybe even alongside a company like Tesla stock in a roundabout way, given the laser welding needs in battery packs. The reality, however, has consistently fallen short of that expectation. Their financials have been weak, and recent reports like the Q2 2025 summary explicitly highlight significant doubts about the company's ability to continue as a going concern without securing substantial additional investment. This constant need for capital, coupled with slow commercial adoption of their original laser products, is the tension that forced the recent sharp strategic change. The stock's recent movement is a direct reflection of this tension. We saw a massive volatility spike a couple of weeks ago, including a multi-day surge largely triggered by the announcement of a $12 million capital raise and the formation of Nuburu Defense LLC. That's a huge amount of capital for a microcap like this, and it gave the stock a significant but short-lived bounce from its 52-week lows. The enthusiasm wasn't for the blue laser, it was for the cash infusion and the new focus. Recent institutional and retail trading activity confirms this narrative shift. Volumes have spiked dramatically on news related to their defense tech moves. For example, the announcement of a binding agreement to acquire Orbit SRL, an Italian software firm specializing in operational resilience, caused an immediate and substantial pop in the stock price. This is a SaaS business, which is a world away from laser manufacturing. This tells you that the market, or at least the speculative traders and some institutional entities focusing on distressed or transforming assets, are now chasing the defense tech acquisition story, not the original blue laser story. The downside of this is the intense volatility. The company's microcap status, combined with the extreme strategic uncertainty of essentially becoming an entirely new business, makes it a target for high-frequency trading and speculative swings, which makes it a very difficult stock for a lot of platforms like Schwab Intelligent Portfolios or typical Fidelity investment strategies to handle, as they often prefer stocks with more predictable trajectories. For those engaged in self-investing through platforms like Robinhood or Interactive Brokers, this volatility represents high-risk, high-reward territory. We've seen a lot of noise that comes with this kind of transformation. The company recently received a warning letter from the NYSE American regarding a disclosure compliance issue not financial, thankfully, but administrative, which relates to their announcement of a dual CEO structure without proper advance notification. While they've since reassured the market they've restored compliance, a warning from the exchange is never a good sign for stability and transparency, especially in the context of a company trying to build an authoritative image in a new, sensitive sector like defense. This administrative misstep put downward pressure on the stock price immediately after the compliance issue was announced, demonstrating how fragile investor confidence is right now. It shows that in a situation where the fundamentals are already strained, any corporate governance hiccup is amplified. It serves as a good reminder that, whether you're trading an established name like Apple stock or a microcap like this, attention to regulatory compliance and corporate communication is just as important as the technology itself. The underlying business of Nuburu, before this strategic pivot, centered on its blue laser technology. Blue light is absorbed much more efficiently by common industrial metals like copper than traditional infrared lasers, meaning faster, cleaner, and deeper welds with less splashing or waste. This is genuinely good technology, making their AO150 and BL250 products relevant for high-speed, high-quality manufacturing. The commercial execution was the problem. They were focused on a capital equipment sales model with long sales cycles and heavy infrastructure costs. The financial reports reflected this: low revenue, high operating losses, and a perpetually tight cash position. This operational stress is what the new management team, led by a dual CEO structure, is actively trying to escape. They are leveraging the intellectual property and name of the company to pivot into the defense and security market, a sector where government contracts offer higher margins and longer-term, more stable revenue streams, often with a more service or subscription-based component, which is what the Orbit acquisition is about: operational resilience, SaaS. Looking forward, the future of Nuburu Inc. is entirely dependent on the successful execution of this defense and security hub strategy. The expectation is a relatively swift, high-growth transition into a defense contractor, but the reality is that acquisitions take time, integration is complex, and pivoting the culture and sales structure of a company is a multi-year project, not a quarterly one. The announced acquisition of Orbit and the framework agreement to evaluate another potential defense acquisition are the primary catalysts. The financial projections for Orbit, showing a ramp-up to nearly $20 million in revenue by 2028, are the numbers the new management is using to sell this story to investors. For the expectation to exceed reality, they must not only close these deals, but demonstrate rapid integration and, critically, start securing new, substantial defense contracts quickly. The risks are clear: integration failure, shareholder refusal to approve the required equity component of the deal, or failure to secure the necessary government clearances and contracts. Given the company's history of cash burn and the fact that they are still operating in a going concern scenario, the margin for error is razor thin. If the market senses any snag in the acquisition plan or any delay in revenue generation from the new defense subsidiary, the stock could easily revisit its lows. This is an all-or-nothing bet on management's ability to fully transform the company from a struggling laser manufacturer to a defense tech consolidator. It's a very high-stakes game. To wrap this up, the story of Nuburu Inc. is a fascinating study in corporate desperation leading to dramatic strategic change. The common expectation of a technology stock rebounding on its core product has been completely superseded by the reality of a desperate yet audacious pivot into the defense sector through serial acquisitions and the deployment of new capital. The key takeaway for investors is that you are no longer investing in a pure-play laser manufacturing company. You are betting on the success of a fledgling defense and security hub. The recent stability in the price is fragile, resting entirely on the continued good news flow surrounding their acquisition strategy and regulatory compliance. The moment that news flow slows or hits a roadblock, the inherent risks of this deep transformation will likely reassert themselves. The move towards a more services-focused, defense-oriented model is a theoretical step in the right direction for long-term survival and stability, but the near-term execution is incredibly challenging. Comment below and tell me, do you believe a microcap technology company can successfully pivot into a high-margin defense contractor through M&A, or is this simply a stalling tactic? Your thoughts on the feasibility of this radical transformation is what everyone is debating right now.